Hi everyone, good morning. So yesterday we completed till question number 20. So today we will be starting 20 question number 21 onwards. So yesterday only we discussed about the cost of equity, what should be higher for which company. So cost of equity should be higher for which company? A company with a $5 billion of market capital or a company with only $500 million of market capital. So if you look at the size comparability, so this company, the 5 billion company is 10 times bigger than the 500 million company, the market cap company. So in question number 21, also we are discussing this scenario forward. So what about the weighted average cost of capital and will it be higher for a company with $5 billion of market capital or a company with $500 million of market capital? So this is a bit of tricky question because it depends on whether or not the capital structure is same for the companies. The weighted average cost of capital actually depends on the capital structure of the companies. If the capital structure is same in terms of percentages and interest rates, and then the WACC would be higher for a company with $500 million, the market capital of 500 million dollars, because uh, because there is going to be risk involved in this in a smaller company. And if the capital structure is not same, then it could go either ways, depending on how much debt to preferred stock each one has, and what are the interest rates. So, so this could be there could be different cases if you think about it. So, weighted average cost of capital actually depends on two main factors: a company's capital structure, that is the mix of the debt and the equity, and the risk of operations also. So, which affects the cost of equity and debt. So, you cannot answer this question solely based on the size, although size often correlates with lower risk. So, bigger size means less risk, and smaller size means high risk. So, if both of these companies have same capital structure, I'm assuming that both of these companies have same capital structure, then business risk will be small for a smaller companies. The business risk for smaller companies are generally are high because of less diversification, and they are more vulnerable to market fluctuations. For example, a $500 million regional retailer might be heavily exposed to local economies, while a $5 billion national retailer can spread their risk across multiple regions. If you think about from the perspective of financial risk, smaller companies often face high borrowing cost because lenders perceive them as riskier. And even if interest rates are theoretically the same, the smaller companies may have stricter covenants. So covenants are actually the terms and conditions which comes uh, when you raise funds or you raise debt from banks or any financial institutions. The covenants is just a fancy name to call it. Only the terms and conditions are there. Those are only the terms and conditions. And for smaller companies, there are going to be higher premiums for raising capital. And if we talk about different capital structure, so if two companies have different financing mixes, so weighted average cost of capital can go either ways. For example, suppose the $5 billion company is highly leveraged with 70% debt and 6% interest rate and 30% equity and 10% if we use those numbers. So it could go either ways. So the key point here is that if everything else is same, smaller companies generally have higher weighted average cost of capital due to higher risk perceived. And weighted average cost of capital is fundamentally a function of both capital structure and risk. So differences in debt levels, interest rates, and business risk can make the relationships non-obvious. And thinking of weighted average cost like the average cost of renting or buying a car, if you think that that perspective, So a big company can rent multiple cars at a fleet discount and spread the risk across many diverse drivers. And smaller companies rents only one car and it's more expensive per car and riskier if anything goes wrong. So smaller companies, if you think from the risk perspective, smaller companies will have higher risk and this will increase their cost of capital. But if you think about from the perspective of how the mix, how the uh, I mean, how the capital structure is mixed, that could go either ways. All right, I think this is clear. Let's move to question number 22. So, question number 22 is about the relationship between debt and cost of equity. So, more debt actually means that company is more riskier. And so, companies' leveraged beta will be higher. And all else being equal, additional debt if raised, it will increase the cost for the company, and it will also raise the cost of equity for the company also. Why? Because if a company is highly leveraged, so if I were to invest in a company which is highly leveraged, then I will, as an equity investor or as a investor, uh, I would want to have more return in that company. So my cost of equity will also go high. And when a company uses debt financing, it must make fixed interest payments also, regardless of how well the business performs. This leverage actually amplifies returns on equity holders when times are good, but it also magnifies losses when times are bad. From an investor's point of view, that extra uncertainty make the company's equity riskier. So investor demand a higher return to compensate for the added financial risk. As a company adds more debt, its leveraged beta increases uh, because the company's earnings and cash flows to equity holders become more volatile. The higher beta then leads directly to higher cost of equity. And to summarize it up all, so increasing debt raises financial risk, and higher financial risk increases leveraged beta. Uh, uh, So think it from this perspective. Let me just discuss the scenario with you. Every year you are raising debt to support your operations. Every year you raise 10 millions of debt. So for 5 years you've been raising debt, and as of now you are not able to stabilize your operations even after 50 millions of debt. So do you think, or do would you as an investor put in money in that company which is not able to uh, which is not able to stabilize its operations in 5 years, or they do not have any revenue model, which any profitable profit earning revenue model. So that's why it's very important to look into a company and do a detailed and thorough analysis to understand the story behind the numbers. And this actually is out of we are discussing, we have digressed to some different point. So let's not discuss that. We will do a discussion session. We'll do a session when we will be completed uh, with this series. And then, so while the cost of equity ties with more leverage, weighted average cost does not necessarily increase linearly because debt is usually cheaper. And up to a point, moderate leverage can lower the weighted average cost of capital also. So excessive debt eventually increases overall risk and weighted average cost the weighted average cost as bankruptcy risk grows. And if someone is raising debt, they actually have to pay interest component. So this is where the credit analyst comes into play. So they get triggered. I mean, they actually have I mean, they have this information on priority. So because being a debt holder, uh, so this is actually a component where the credit analysts come into play. So they will be able to, I mean, they will be triggered the first instance of a company is about or is on a verge of bankruptcy. So debt is very important, and there is certainly a relationship between debt and the cost of equity. So let's move to question number 23 now. So question number 23 is about the cost of equity tells us what kind of return an equity investor can expect for investing in given company, but what about dividends? Shouldn't we factor dividend yield into the formula? And this is a trick question. So basically dividend yields are factored into in beta because beta describes a return in excess of the market as a whole. And those returns actually include dividend. Uh, Here is the formula for beta as per here is the formula for CAPM, capital asset pricing model. So if you think about this, this is the risk-free rate RF. This is the expected market return, which will include the dividend yield. This RM component will include dividend yield. And beta, if there is beta, this beta is representing the relationship of this stock with relation to the market. So cost of equity measures total. So cost of equity actually measures total expected return and not just capital gains. And CAPM beta is based on total market return. This return is actually based on total market return and it includes the dividend yield also. And adding dividend yield separately would double count uh, that part in the return. So this is actually a trick question and don't get confused. So if they are using the market data, this means this market data includes a dividend yield. This return on the market RM includes the market yield. Let's move to question number 24. Okay, so how can we calculate cost of equity without using CAPM? And there is an alternate formula for this, which is the dividend discount model or cost of equity. So here, this formula, this is less common than the standard formula, but sometimes you use it for companies where dividends are more important or when you lack proper information on beta. And there were and other variables that go into calculating the cost of equity with CAPM. So this is commonly used in banking and finances. We talked about it in our previous videos. So CAPM, capital asset pricing model, is the standard approach to estimate the cost of equity. It's not always practical, especially if we don't have reliable market data for beta, risk-free rates, or expected market returns. In such cases, an alternative method, this is the dividend discount model, and also known as Gordon growth model. So just remember this formula. So this one is the dividend next year. This is the price right now. So price is right now, dividend is this, the dividend expected this next year, and we are expecting a growth rate of G. So this model actually estimates the return required by equity investor based on dividends received plus the expected growth rate on those dividends. So it works best for the companies that pay regular and predictable dividends. If your dividends are not regular and predictable, so you will not be able to use Gordon growth method also. And this actually works best for mature companies, dividend paying companies like utilities, consumer staples, not suitable for high growth companies or non-dividend paying companies. If a company is not paying any dividend, previously it's been holding on to its dividend, then you will not use golden growth method, and it requires estimating a reliable dividend growth rate, which can sometimes be challenging. This growth rate, if there is no this growth rate, we actually have to forecast this growth rate, and uh, it should be reliable, and this can complement CAPM or can be used when beta or market returns data is not reliable. So let me just show you how this actually works. This is not this question, cost of equity. Okay, so let's assume this is the formula. CAPM, this is the formula for the dividend discount model, cost of equity. We used in CAPM, so weighted average cost of capital. Weighted average cost of capital is made by all these components: cost of equity, cost of debt, weight of debt, and we subtract taxes, and cost of preferred equity and weight of preferred equity. So we are only talking about this cost of equity. Cost of equity, if you're calculating the cost of equity component of a dividend discount model or using dividend discount model, Gordon growth model. So let's assume that there is this current price, there is a stock which is currently trading today. Price, this means P0 means, or time zero means price today, P0 and time zero. Time zero is today, time one is next year, time two is next to next year, and time three is next to next year. If it's 25, it's 2025 today, 2026, 27, and 28. If you think it from the perspective of years. So I have plugged in these numbers. So 50 means this is the current price, expected dividends. But dividends are expected here. Next year, the dividends are going to be $2. This is not, this is dollar. Let me just fix it one moment. So this is $2. Okay. So if I plug in these numbers into this formula, we have dividend at time dividend and time D1, dividend and type 1. We have current market price P0, and we have growth rate. So dividend cost of equity, I will be able to calculate the cost of equity. So what I need to do is I will start with dividend is let's start with dividend D1. I will divide it by uh, this current share price P0, and I will add my growth rate. So this is going to give me, okay, this is going to give me a cost of equity of 9%. I hope this you have understood how I calculated this thing. And now let's move a little step further. Uh, so can I calculate using this formula the cost of equity and all this? Can I calculate the next year's share price using all this data? I have the formula, I have the numbers, so I want to calculate the time one. What should be the share price at time one? So now think about it. uh, let's see what we can do. So if I need to do a little if I want to calculate the dividend. So at now, this is time zero. Let's assume that this is time zero. We have the cost of equity numbers. We have okay, we have expected growth rate also. So we are expecting that the dividend is going to grow at a rate of 5%. 1 plus dividend growth. Dividend is going to grow at a rate of 5%. So this will not be wrong if I say next year the dividend will be 2.1, and next to next year the dividend will be 2.2, 0.05. So now we have dividend at time 2. What would be the P1, price at time 1? So if we do a little reshuffling of the formula, what would happen is we can subtract cost of equity. So if I were to calculate this, so what I can do is I can subtract growth rate from cost of equity. I will subtract cost growth rate from the cost of equity. I will divide it with, I want to calculate price at 0. And then I will use this and I will divide it by the dividend at time 1. So cost of equity, we have subtracted the growth rate and we will divide. Okay, so we will divide the next year's, not C21, but D21. So this will give us a cost of, so this will give us the share price at time 1 at as 52.50. I hope this is clear to you guys. So this is how I need to freeze these two because I do not want them to drag, but I would want this column to drag. So if I want to calculate the stock price at time 2 using that, I will just show you. What is now wrong with this? Okay. 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 Let me just fix this. I do not want to drag. I want this whole to stay. Okay, I have only now this was creating the issue. So now understand this thing. If dividends were expected to grow at this rate, and this was the data we had. So using this data and a cost of equity of 9%, we have calculated the share prices for the next 2 years at time 1 and time 2 in using this simple formula. So if you are holding this share, if you are holding this stock, and if prices go above 52.5, and as per your valuation, the stock, this is the exact fair price at the stock, which the stock should be trading at. So if the stock goes for like $55, so you will immediately sell your $50 share, and you will record the profit of $5. And if your stock goes below any point below this, so you will uh, investigate whether or not to keep this stock. So I hope this was clear and this made sense. Just to deliver a just to make a 1 hour or half-hour video, I actually have to do a lot of digging. I hope this actually helped you guys to understand a dividend discount model, how it works, and along with the formula. So we have covered this, and we will talk about the other things in the next questions when we will do the next questions and relevant questions. So I hope this was clear. Dividend discount model, and it works best for mature companies, dividend paying companies only. So if the company is not paying dividend, then it's useless, because this is the main these three are the major plugins to calculate the cost of equity. You want the dividend at the time, next year's dividend, current year's stock price, it could be available, and this you actually have to forecast. So these two plugs, P0 and G, growth rate, you actually have to the growth rate you actually have to forecast. Price you will get from the market, from the market data, and dividend, but you actually have to get the dividend. If you do not have the access to the dividend numbers, no, then it's useless. The company's forecasted dividend numbers, whether or not when they are going to, and how much dividend they are going to give. So this formula will not work. So let's move to question number 25 now. Two companies are exactly same, but one has debt and one does not. Which one will have higher weighted average cost of capital? And this one without debt, and the company without debt will generally have higher cost of capital because debt is less expensive than equity. Think about this. So interest on debt is tax deductible, and if you are not having any debt, so you will have high tax rates. And debt is senior to equity also. So you pay debt before equity in company's capital structure, and debt holders would have been paid first in liquidation or bankruptcy scenarios. And intuitively, interest rates on debt are usually lower. They are usually lower than the cost of equity numbers. So if you go to a bank, so bank will charge you 7, 8, 9, 10%. But equity holders, uh, they would want on above of 10% because uh, so what's the whole use of that? So if bank is charging you 7%, and if they give you their money to the bank will get them 7%. So they would want more than that, above of 7% or above of 10%. So equity numbers, usually see that they are usually above 10%, and this actually, as a result, the cost of that portion actually increases the weighted average cost of capital. So the debt is usually cheaper than equity, and interest rates are tax deductible. These are the points which you need to keep in mind. And if you okay, let me just show you my screen also one more time. Weighted average cost of capital. Okay. So let's assume a company, there are two scenarios. Let's make two scenarios. So let's assume that the cost of capital for a company, there is 50% debt. There is 50% of debt. Uh, no, 50% is the weight of equity, and we are assuming 50% as the weight of debt. Cost of equity, I'm assuming 12%, and cost of debt, because cost of debt is lower, so I'm assuming 7%, 0.7%, 0.07%. So on debt, there is going to be a tax rate. I'm assuming tax rate is 25%. There is going to be a tax benefit. So this will give me cost of equity multiply by cost weight of equity and cost of debt multiply by weight of debt, and we will multiply this with 1 minus tax rate, and this will be calculated at 8.625%. If you want me to put in, this will calculate to be 9% total, somewhat around 9%. And if there was no debt, and we calculate 100%, so the cost of, so here in this case, debt plus equity is there, and in this case, only equity and no debt. If you ever get confused, try to solve these questions using an Excel. So I hope this was clear. So without debt, the equity cost will increase, and with the debt, even okay, even if I reduce the cost of equity also to 0.07%. Okay, no, 0.07%. Not in this case. But here, if I reduce the cost of equity, should I? The cost of equity should be, but the cost of equity is always higher. So even though the cost of 50% of the equity is 50%, even after 50% component of equity, the cost of equity is 12%. And total, and with after having debt, the cost of equity has reduced to 9% now because of the tax shield. Because tax on the rest of the portion, there was a tax shield of 25. So we actually pay 25% and the rest of the 75% we use that. So understand this thing. After including debt into 50% weightage of debt in the cost of capital, it has actually reduced our total cost of equity. Sorry, total weighted average cost of capital. So I hope this was clear now. Uh, let's move to question number 26. Okay, now. So question number 26 is about DCF valuations and which has a greater impact on a company's DCF valuation, a 10% change in revenue or a 10% change in discount. If you remember, previously we have discussed about this here. Uh, Let me just show you here in this example. So DCF here in discounted cash flow, we are only we are discussing about DCF. We we discount using a discount rate of 12%. We are here discounting at a rate of 12%. And these numbers, these numbers which we are discounting, they are driven by the financial statements. So we have calculated uh, unlevered free cash flow and then we have discounted them back to the original original place. So DCF is sensitive to discount rate. And to calculate this unlevered free cash flow, we have used EBIT, 1 minus tax rate because of the tax shield. Depreciation we have added back. We have subtracted capital expenditure and we have subtracted net change in working capital. So I hope this formula you remember. So let's now move to let's now go to the Excel. Let me just show you the Excel where it is. Okay. Uh, the question was 10% revenue is up and 1% change in revenue 10% and change in discount rate 1%. So if revenue is changed by 10% and discount rate is changed by 1%. So here I have made an Excel for you folks. Free cash flow is calculated by EBIT, margin, revenue. If we start from revenue, it was EBIT into tax rate. So EBIT margin into revenue will also give you the same number. So I have included revenue here. Revenue as a percentage. Out of that, as a depreciation as a percentage of revenue and capital expenditure as a percentage of revenue and capital change in working capital as a percentage of revenue. We add these two, we add back depreciation and amortization, we subtract capital expenditure and we subtract changes in working capital. We have just discussed it. So I have taken a scenario here. So I am assuming that revenues, these are the revenue numbers. All for all the years, these are same. I am assuming a EBIT margin of 80%. EBIT margin means 20% is the after everything, all the expenses. This is the EBIT, 80%. And after that, tax rate is 25%, depreciation and amortization 10% of revenue, capital expenditure is 25% of revenue, and changes in working capital is 30% of revenue. The discount rate is 10%, and we will use this discount rate to discount all the values back to the present value. So we are talking about DCF. Question, let me take you question, or let me take you back to the question. DCF. We're talking about DCF, and here, remember this thing. So we discount everything back. We discount everything back here. So this is what I am showing you in the Excel. So here I have done what? I have taken the revenue numbers. I have multiplied it with EBIT, and I have this formula. I have just applied it like the formula. So revenue into EBIT margin into 1 minus tax rate. Then I have added here B4 into B7 means B4 is revenue into B7 is depreciation and amortization. Depreciation and amortization is as a percentage of revenue, and I have subtracted capital expenditure B8, and I have subtracted changes in working capital after multiplying it with revenue. So I have received 1500. So if I have received, uh, if no changes are there, if there are no changes, okay, let's assume that this is 10,000 and this is 12,000. This is 16,000. The company had revenue 16,000. This year, company had revenue of 19,000. And this year, the company has a revenue of 21,000. Okay. So this we have assumed, and these I have kept constant, the assumptions. These are the assumptions. Uh, Let me just do a little color coding here so that you do not get confused. These I have assumed. These I have forecasted on the basis of revenue assumptions. Now, this is what we are discussing. And revenue is grow if the revenue grow by 10%. And this is the case where, okay, this is the case if okay, if revenue is grown here, this is the case where I have increased the revenue by 10%. Okay, so if revenue increases by 10%, this formula will look like this. And I am assumed that there is a terminal value and I have kept the terminal value constant. So if I find out the net present value at time zero, so the net present value of time zero is sum total 11,040. If the discount rate is down by 1%, so the net present value will be 11,410 and it will actually increase. The net present value has actually increased. But if the revenue numbers, the net present value at discount rate, if we have increased the revenue numbers, so there the by 10%, that actually had a huge big impact rather than 1% down in revenue and in the 1% down in uh, discount rate. If I increase the discount rate by 11, so increasing the discount rate will actually reduce the value, but decreasing the discount rate will actually increase our value because we are discounting it by a lesser number. So this means the required rate of return is less here. So this required rates of if the required rate of return is less, this means we have more money, the valuation is more. If the required rate of return increases by 1%, the valuation falls by the valuation falls down. And It's difficult to infer what actually is happening. So discount rate is down by 1%. This means the valuation will increase and revenue is up by 10%. Okay, let's increase. So up, this has actually a positive impact. Revenue is up by 10%, and this actually has a negative impact. If the discount rate went up by 1%, and if you see the change in how much the revenue went up as comparison to the base case scenario, and how much the revenue went up. So here the valuation has increased, and here the valuation has decreased as compared to the, okay. And if I subtract this from this, the net present value has decreased if discount rate went up, and the net present value has increased if the discount rate went down. Sorry, if the revenue went up by 10%. And if I were to revenue growth 10%, let's assume it's zero. Okay, so I have not plugged in it anywhere? Okay, because I have multiplied with these numbers, 1.1. So basically, you have got under. I think you have understood the. You have got the gist. Revenue, if the discount rate is going up, this is a drawback for us. The costing will increase. The weighted average cost will increase, and we just discussed cost of equity should be weighted average cost of capital should be low for us. This will help us. This will help us giving the net present value high net present value and increase our stock price. This will reduce our stock price. The higher the weighted average cost of capital, the lower will be our net present value. I think next question is also in relation with the same, this kind of question only. So which has greater impact? So greater impact it depends, but most of the time 10% difference in revenue will have more impact. That changes in revenue. That changes in revenue does not affect only the current year's revenue, but also the revenue by EBITDA. So far into the future, even the terminal value. So 10% change of revenue will have more impact. And if you talk about question number seven, so question number seven has what about 1% change in revenue versus 1% change in discount rate? If Okay, let's go to the Excel again one more time. Okay, so if revenue were to change by 1%, here I will actually have to plug in 0.1 so that it gets only changed by 1%. So this will actually change everything. Even though the revenue has increased, but it it has increased at a decreasing rate. So revenue is up by 1% only here now. And if discount rate was to change, it could be up or down. If the discount rate was changed by 1% down, so it would have a higher impact. So it should be favorable. So you always have to ask, should is 1% revenue change is positive or negative? 1% discount rate change is positive or negative? So in this case, discount rate is actually likely to have a bigger impact on the valuation. But the correct answer should start with. It could go either ways, but most of the times, this you actually have to confirm whether the revenue 1% change is positive or negative, or discount rate 1% changes positive or negative. I hope using Excel actually helped to understand you, because making this Excel actually took a lot of time of mine, and I hope it was worth the trouble. Let's move to question number 28. So how do you calculate a weighted average cost of capital for a private company? Okay, so for this, we discussed about leveraging, unlevering, levering, and then relevering. So let me just show you one example which I have found somewhere on the internet so that you would benefit from that. So how it is done actually. So question problem 29, 28. So how do you calculate the weighted average cost of a, so how do you calculate the weighted average cost of a private company? And this is actually problematic because private companies do not have market caps or betas. And in this case, you are likely to estimate weighted average cost of capital based on the work done by other valuation specialists, or based on what weighted average cost of capital the public companies have. So I'm assuming, suppose there is this question, the private company has a target debt to equity ratio 1:2. So I will compare using the weighted the debt to equity ratio. So the other company should also have the same debt to equity ratio. So we are targeting towards the debt to ratio 1:2. So you select a comparable company with an leverage beta of 1:2. They have a leverage beta of 1:2. So the beta, market beta, this is market beta 1:2, and the debt to equity ratio is 1:1. So first you will do, and the corporate tax rate. So these are the details of the other company, and these are your details. So these are the details of the other company which we are using to calculate our, so which we are using, or whose beta we are using. So understand this thing. How do you unlever the beta? And this is a simple formula here. You need to remember this formula, but it's easy, not that difficult. So this is your beta, beta of asset. So there is this beta asset and beta equity. So you are unlevering the beta. This means that the beta of 1.2, this is the beta, and the tax rate, you are using their numbers, and you are using the beta of the asset. So just understand this thing and don't get into detail. We will discuss about it when we will talk about the levering and unlevering of the beta. This is just an example for reference. Understand this thing. First, you remove all these impacts from the beta. So this is now the free beta, 0.68. This you have freed from the debt and equity, and you have freed it from the corporate tax rate. So you have taken a beta. This is the free beta. Now you will relever the beta one more time using your numbers. So your debt to equity ratio is 1:2. This means tax rate is 75%. This is the tax rate. And 1:2 means you have 50%. So this means that 1:2 means 0.5. So this will get you your beta. So assuming a risk-free rate of 4% from the market, and market risk premium is 6%, this is how you actually calculate the capital asset pricing model. This is how you actually calculate the cost of equity, R of equity, rate of equity. The question was, how do you calculate weighted average cost of capital? So now you have calculated the cost of equity and cost of debt, because there is 1:2 ratio. We are assuming that there is 6% interest rate on the debt, corporate tax is 25%. So after tax cost of debt is 4.5%. And using these two plugins, you can calculate the weighted average cost of capital. I hope this made sense because this formula we will discuss in detail when we will discuss about the leveraging and releveraging, unlevering, relevering of the beta. And I need to make a whole detailed video on that. So here, if you understand this, if you have understood this, what you need to understand here, how do you calculate the private company's beta is that uh, you need to relever and lever and unlever and relever the beta. So from the public company data, you estimate you get a free beta, and then you use your company financials and your company data, and you relever the data. You relever the beta, and then you calculate the cost of equity. The cost of debt can be calculated using the interest rates and the weight of debt and the tax rate. Then you put it in the capital structure weights. You calculate the weighted average cost of capital. And for private companies, weighted average cost of capital is usually an estimate and not a precise number. And you use comparable public companies to infer beta and capital structure. And also, cost of debt is often derived from actual loans or industry benchmarks. So I hope this actually made sense. Let, let's let's I would want you guys to just understand this problem for a moment. Just go through this if you could make any assumptions. I hope this was clear. So let's move to question number 29. And there are only few questions left in this reading. So question number 29 is about what would you do if you don't believe in management's projection for a DCF model? Uh, so if you think that management's projection, if you don't believe in them, so you can create your own projections, and you can modify management's projections downwards or upwards to make them conservative or aggressive. What you can do is you can do a sensitivity analysis based on different growth rates and margins and show the values assuming management's projections and assuming a more conservative set of numbers. And in reality, you would probably do all of these if you think that the management's uh, projections are unrealistic or you don't believe in them. So let's assume that management has projected that revenue growth will be 15% for a company, for a SaaS company, so software as a service company with the improving margins. And you noticed that historically the company has been only growing at 7 to 8% only. And the competitor in the space are only growing at around 10%. So if that's the scenario, and I mean, by using what assumptions the management is projecting that the revenue will be 15% growth. So you will do what you will do. You will prepare a set of your own projections or adjust management's number, run sensitivity analysis. Uh, you will forecast the numbers somewhat around in between the management's forecast and what's happening in the industry or other competitors, what's happening with other competitors. Create a conservative or a aggressive management case, version of management case, and then you will show a sensitivity table combining different growth and margin scenarios and clearly illustrating the impact on the valuation. So the goal is not a dismissal of management solution outright, but to present a thoughtful, data-driven view by showing multiple scenarios, aggressive case, conservative case, management case, base which would be the base case, and provide a more complete picture of risk potential, which is critical for credible financial analysis. I hope this was clear. So let's move to question number 2930. Why would you not use a DCF for a bank or financial institution? And we have discussed this previously also. Bank actually uses debt differently than other companies, and do not reinvest it in businesses. And they use it to create products like loans instead. So, and also interest is a critical part of bank's business model, and changes in working capital can be much larger than a bank's net income. So traditional measures of cash flow do not tell you that much. For financial institutions, it's more common to use this dividend discount model or residual income model instead of a DCF, because there you do not need to calculate the free cash flows. And like we have discussed, let me just show you the formula one more time. Okay. So if I am saying the changes in working capital are bigger than the changes in net income here, revenue component, so this will not make sense. So you cannot have a negative free cash flow, and having a negative cash free cash flow even after forecasting, this will not make sense. So that's why for banking, it's not advisable to use a DCF. And debt and the interest components, they are actually a part of their business models. So even if I had to calculate the leverage free cash flow, so net borrowing after subtraction of cash, so this number is going to be a negative number, and this number will be again a negative number, and this will have a huge impact on this levered cash flow also. So even if you calculate levered or unlevered cash flow, these numbers are going to be negative if you are using a DCF, or you if you are using a if you are on the if you are if you are valuing a bank or a financial institution, so it's not advisable to use a DCF for banking institutions or banking or financial institutions, and this is the main reason why. So free cash flow is not meaningful for banks, and interest income and expenses dominate operations. Working capital changes can overwhelm net income. They could be more than net income working capital changes. And that's why the alternatives are dividend discount model and residual income model. Traditional do not, but traditional DCF do not captures the bank economies accurately, because cash flows are dominated by deposits and loans, and interest is operational, and also working capital swings are huge. So that's why DCF is not advisable. Let's go to question number 31. But what type of sensitivity analysis would you look at a DCF? So, um, in a typical DCF, the sensitivity analysis which we consider are revenue growth versus terminal multiples, EBITDA margin to terminal multiples to discount rate, and long-term growth rates versus discount rates, and any combination of these. mm, are the sensitivity analysis that we look into. So, The why we do that is sensitivity analysis actually highlights the uncertainty in DCF outputs. And the most critical sensitivities usually involve terminal values because it drives the majority of the enterprise values. And terminal value actually, if you look at the Excel here, terminal value actually captures somewhat around 750 to 70% of the whole valuation. So we cannot, so this number, the DCF will be sensitive around terminal value, and this number cannot go wrong. So terminal value cannot go wrong. That's why we include terminal value in sensitivity analysis. And analysts actually use a 2D table in Excel to quickly generate these numbers, these analysis, sensitivity. And during presentation, always emphasize which variable your valuation is more sensitive to. Uh, so if you say that your valuation is sensitive to revenue growth, so emphasize on revenue growth. Terminal multiple, emphasize on terminal multiple. Okay, so just give me a moment. Let me just show you how does sensitivity analysis of a how does the sensitivity analysis looks like of a company. So look at this diagram here. So this is a heat map. So this means this heat map is representing here sensitivity in between exit multiples and weighted average cost of capital. So DCF can also be used, and so exit multiple is about uh, terminal value is calculated using exit multiples, or we use a perpetuity growth rate. We have discussed this. Here we are using an exit multiple approach, and we are checking the exit multiple, the terminal values using exit multiple approach, and the weighted average cost of capital, terminal multiple, and weighted average cost of capital. Now see this. I understand that this is downwards, and yes, this is actually how the heat map is made because this way, this is the value at the maximum valuation, and this is the value at the lowest valuation, and this is the highest heat. This is the highest heat, and this is the best. This is the best case scenario and the worst case scenarios. That's why it's made like this. It's not inverted, but this is the correct way. You might be thinking that if it's zero, so these numbers should also be increasing, but these are decreasing down there. Let's discuss about this heat map first. So at a weighted average cost of 10% and a exit multiple of 8, this is the valuation. So DCF is sensitive here. And as we move out, so DCF is less sensitive. The more we go in, the more we go inside this, so enterprise value decreases, starts to decrease. So this is what happen. This is what is happening. The enterprise value is decreasing as the weighted average cost of capital is increasing. So with an increase in weighted average cost of capital, enterprise value is decreasing. And with an exit multiple, decreasing exit multiple, the weighted average cost, the enterprise value is decreasing here. So typically, the I think you might have understood what I'm trying to convey here. So types of sensitivity analysis: revenue, terminal value, EBITDA margin, terminal multiples, discount rates, long-term growth rate, discount rates. So we just did a weighted average cost of capital, the growth rate or the discount rate versus terminal multiple. Discount rate versus terminal multiple. We just did this one. Let's move to question number 32, our last question. Uh, a company has high debt load and is paying off a significant portion of its principal each year. How would you account for this in the DCF? And this is actually a trick question, and you do not account for this in this at all in unlevered DCF, because paying off debt principal actually shows up in cash flow from financing on the cash flow statement. But we only take into account the EBIT into 1 minus tax rate, and then uh, a few items from the cash flow from operations, and then subtract capital expenditure to get the unlevered free cash flow. So if you're looking at a levered free cash flow, then our interest expense would decline in future years due to principal being paid off. The mandatory debt repayments would also reduce the levered free cash flow. But if you think about it, repaying the debt really does not reduce the free cash flow that you can go to equity investors. So it should be subtracted out here. Let me just take you to the formula one more time. I hope this would make more sense. So they're talking about if you are paying off your debt. So there here and it will not have any impact on the unlevered free cash flow and interest component. If you are paying off your debt slowly, yes, it's going to be here. So there is going to be a little or I mean, if you're looking at levered free cash flow, then our interest expense would decline over future years decline over future years due to principal being paid off. So the mandatory debt payments would reduce the levered free cash flow. And in an unlevered free cash flow, you do not model uh, principal repayments at all. And these financing cash flows are excluded since we are valuing enterprise value based on operational performance, not. And however, in leveraged DCF, which values equity directly, mandatorily principal repayments are subtracted from cash flows since that cash is no longer available to the shareholders. So over time, it this also impacts interest expense, which would decline as debt is repaid. If now understand now think about this. If the company has high debt real if the company has high debt load, so should not we reflect this risk somehow? High debt load. Uh, you can think of it somehow, yes, but we do not reflect it by adjusting the cash flows actually. Instead, the risk of high leverage is reflected in the discount rate. So never get confused. So if they are talking about debt and they are saying why the unlevered free cash flow, free cash flow is not accounting it because it's the increase in risk. So we do not adjust the unlevered or levered free cash flow, but you adjust the discount rate if the risk is high, if the debt is high. So because the risk of high leverage is reflected in the discount rate. So never get confused in these kind of questions. And if you go through this was actually a trick question. And unlevered free cash flow ignores the principal repayments, and levered DCF subtracts mandatory debt repayments and reflect declining interest expenses. And by and with this, we have completed our discounted cash flow series. Basic questions. And in the next reading, we will start with our advanced questions on the discounted cash flows. I hope you enjoyed the session. And if you have learned something of value today, please subscribe to my channel. Thank you. and all the very best learning.